We continue with our discussion on the model we were trying to build, and we're going to try and now build in a fully linked model, a fully dynamic model, for which we will need to project the cash flows. Right now, to project the cash flows, it is important for us to first identify that for the next year in consideration, which in our model is FY16, what data points do we need? So we need the car sales. That's an assumption. And I'm going to put in the assumptions in yellow here, right? We will need cost of material per car as an assumption. That would be needed. All the other headers could basically be, in terms of the percentage of sales numbers that we have seen, we can just incorporate them as percentage of sales as an average. Right? So I can find out what are these headers as a percentage of sales and put an average to that. So we can do that right away. We can just introduce a column beneath each of these other than the cost of material, a row beneath each of these. Other than the cost of material, I'm going to put everything else as a percentage of sales, right? So this as percentage of sales. And I take 1278 and divide it by the sales number. What's the sales number? Revenue from operations. Convert this to percentages. We can freeze the sales column, and when we drag it on the right side, we want C to change to D, but we don't want 14 to change, right? So what I do is freeze the row but not the column, drag it on the right side. Do we get the cells correctly? We get the cells correctly. So this seems to be increasing. I can then copy and paste this, copy and paste this, copy and paste this, and this broadly, right? So now our projection points for the next year become, what will this be as a percentage of sales? This be as a percentage of sales? What would employee benefit expenses as a percentage of sales be? What will other expense be, and what will vehicles and die for own use be, right? And what is it that is going to be cost of materials as a percentage of sales? Similarly, what would working capital data be as a percentage of sales? And just to kind of keep things simple, I'm going to use the average of the last 3 years for some of these cells, right? So let's just do a simple average of the last 3 years, and assume that the average is what is going to drive the value for these particular years, right? Similarly, I'm going to find the average over the last 3 years for each of these, right? So what is the average here? What's the average here? Average, average, average. You could do it differently as well. There's no rule that you have to just find averages everywhere. It is just that it might make sense in terms of understanding what is the average here. And cost of raw materials, you will probably see that it is it's gone down, then gone up a little bit. So again, I think an average of the last 3 years might make sense. Selling price of the car, we can debate whether an average makes sense, whether it will go down. It seems Maruti has hiked selling prices, so I'm just going to assume, let's say, a small increase in this. Let's say this increases by 1.02. What does that mean? 1 plus 2% increase in the car's selling price. So that's the selling price increase we're looking at. Let's assume volumes are 13 lakh cars this year. From 12 lakh, the numbers have gone to 13 lakh cars, right? Now, let's try and identify what is going to be the cost headers. So we can actually find out what the cost headers and revenues are. So revenues are going to be number of cars into the selling price of car divided by 10 raised to 7. We get this number of revenue here, right? Cost of material can be calculated as number of cars multiplied by the cost per car divided by 10 raised to 7. These are all assumptions, remember, hypothetical numbers. We're just trying to build in a fully functional model. Everything else is a function of what's the sales, right? So I can do this, and let's just move the decimals and Control C and Control V for all these headers. And we have our P&L more or less ready with us, right? I can go to the P&L now, and for FY16 put in these numbers. So where is my assumption sheet? That's here. This is my gross sales. Let's assume excise duty remains the same as last year. So that's my net sales. Let's assume other operating income and other income also remain the same as last year. These are assumptions, remember. So this is an assumption and these are assumptions. We can work around these assumptions as we go along. So what is the total operating revenue? That's this. I can go and link in all the costs as well. So that's my first cost. I can link in this to here. Employee benefit expenses are going to come in here. Other expenses are going to come in here, and this is going to be my final set, which is vehicles ties for own use, right? That gives me a total operational expenses number of this, which is nothing but a sum of all the 5 headers. I will get my EBITDA margins from this. Can I get my EBITDA margins from this? I can. Since the company has not increased its capacity, let's assume the company has not really increased its capacity and it stays where it is essentially, right? So I'm going to keep it here and the capacity stays where it is, then there is no capex, right? So because there is no capex, I can also safely assume in this particular model, it's a simplistic model, the depreciation to stay the same, which gives me my EBIT number. I'll assume the finance cost to remain the same because there is no new debt that has been raised, right? We can actually link a little bit of this with the data set that is there, and that gives me EBT. Let's say taxes are at 24%, and that's an assumption. So effectively my tax would be 24% into 5706, and that 5709, and that would give me my final profit number, which is 4339, correct? So I start with this, and that's the P&L completed. There are a couple of cells which are not completely dynamically linked, which is finance cost is kind of fixed and depreciation expense is fixed. We can try and model those as well at some point of time, trying to make it completely dynamic, right? Now we go to the balance sheet. We realize that share capital stays the same. My reserves and surplus adds whatever profits I have during the year, right? So reserves and surplus goes up by that amount. We have not assumed any new debt in our discussions, right? So capex is here and debt equity is here. So what is the capex and what is the debt equity going to be? Because there is no new debt, what I'm going to do is on my balance sheet, I'm going to link this 145 with whatever is the debt number here, right? That doesn't change. Some of the other headers will basically, let's assume them to remain the same. No change in any of these. So all of this remains the same. We go back to our assumption sheet and go down here, and we have said that all these numbers are a percentage of our revenue number. So 1.5% multiplied by what is my revenue number, right? So that gives me the short-term borrowings data, and I can drag it down. So we get all the other data as well, right? So that's basically the data we were looking for in terms of current assets and current liabilities. I can go to the balance sheet and link this data directly, right? So these 4 cells get linked, and that's basically the total current liabilities portion. And we have now successfully completed the total liabilities side of things, right? What is my total fixed assets number going to be? What is my total fixed assets number going to be? Remember, this is the net number, net assets. So my fixed assets are going to be this minus whatever is the depreciation for the year, plus if we have done any capex here. If there is any capex here, it is going to add that number here, correct? And that reminds us that we've probably made a small mistake somewhere in the debt data, which is on the balance sheet. When we were linking the debt, we have linked it to capex schedule F15. It shouldn't be F15, it should be, for FY16 we are looking at, so it should be G15, right? Doesn't change the numbers, but that's fine. My capex, remember, is last year fixed assets minus the my gross total fixed assets, net fixed assets is last year fixed assets minus the depreciation, which is loss of value, plus any capex we've done this year, correct? And let's assume all these investments are the same as last year for a while to keep our understanding on this intact. And we've already projected some of the investments. Current investments is the same as cash, so I'm going to keep that constant as last year. We've projected inventories, we've projected trade receivables, we've projected short-term loans and advances, and we've projected this bit, right? That gives us a certain data point, and we note that the balance sheet doesn't balance by this amount. That's the difference between the total assets and total liabilities. That's because we have not plugged in any number for cash. Now, where will the number for cash come from? The number for cash will come from the cash flow statement, right? So how do we build the cash flow statement? We start with the net profit. We add depreciation, right? Less any capital expenditure, or less, let's start with less changes in net working capital, less capital expenditure, right? Add changes to debt, and that's my total cash flow. Opening cash balance and closing cash balance. Right, now what was the closing cash balance of last year? That's available on the balance sheet. That's this 18 crore number. What's the opening cash balance of this year? That's the last year closing cash balance, correct? Do I have some of this data already with me? Net profit is available on the P&L, last cell, calculated. Depreciation is available on the P&L. Here we go, 2470, linked it. Capital expenditure is available on the capex schedule. That's this cell, right? Nothing available here as yet. And changes to debt is also available on the capex schedule. Here, I can link it here. That's 0 as well, right? I can just drag these two here so that the formula fits in. I will drag this here so that the formula fits in, right? Now, we'll also look at what happens if we change the capacity at some point of time in our calculations, because our model should be dynamic and it should link everything correctly, right? That's my cash flow numbers. The one number we don't have is the changes to working capital, net working capital. Now, what is net working capital? Net working capital can be calculated as CA minus CL. In other words, non-cash current assets and current liabilities. And the change between these two is net working capital, the difference between these two. How do I calculate non-cash current assets? That's, remember, the sum of inventories and trade receivables and short-term loans and advances and other current assets. I have left out both current investments and cash. Why? Because these are non-cash, we're only looking at non-cash current assets. Current liabilities are all available on the top. The sum of total current liabilities is here, so that's the data. My net working capital is non-cash CA minus CL, right? We can just drag it on the right side and we get the data as such. What is the change in net working capital? That's this year minus whatever is the number last year, right? So that's the change number. And for FY16, that change is 378. So I need to go to the cash flow and link in this number, which is on the balance sheet, 378, correct? Now let's look at what is the total cash flow. That's 4339 plus 2470 minus 378 minus any capex plus any debt inflow. And that gives me a number which is 6430. What was the cash I started with? That's 18. So the total cash at the end of the year is 6448, correct? That's the cash at the end of the year, and that should go and sit in my balance sheet here in cash and bank balances. So that's 6448. I link it, I close it, and we realize that the balance sheet is balancing now. Total assets are 37,798. Total liabilities are 37,798. This now is a completely linked model, right? If I go to the capex schedule and change the capex slightly, which is, let's say the company adds 5,000 cars as capacity, right? So there is a capex, there is a debt, right? So now there is a 75 crore capex, 75 crore going out, 25 crore debt, 25 crore coming in. That should mean my cash flow should show minus 75 plus 25. So the cash number should change by 50 crore and final number should change by 50 crore as well. And my balance sheet should still remain balanced, correct? So whatever I change here, wherever I change here, if I go on the assumptions and change one of the prices of the car, instead of 2%, I say it only increases by 1%. Everything else remains the same. My balance sheet should stay balanced. There is no reason for my balance sheet to not stay balanced at this point, right? And that is the beauty of a completely linked model. That's the importance of creating a completely linked and fully dynamic financial model. All we need to do now is focus on the assumptions, and the numbers will automatically flow in during our calculations. It is important to understand what are the signs that we have used on the cash flow. Remember, this is plus, this is plus, this is minus, minus, and plus, right? So I can write plus, plus, minus, minus, and plus. And those are the signs we have included here. Once we do that, we arrive at the final closing cash balance. The closing cash balance has to go and sit in my balance sheet on the cash side. And even after doing that, at the end of all this changes, my final balance sheet number should stay balanced. That, in a nutshell, is a fully dynamically linked model. Thank you.